Hello, everyone. So, we are super excited for this episode and chatting a little bit about some updates with the new big, beautiful bill. It has a lot of people wondering what it means, what's in it for them. So, for those of you who don't know me, I'm Mrkall Overkamp, the CEO and founder of Wilcox Financial Group, which is a boutique financial planning firm where we specialize in holistic, comprehensive, fee-based financial planning, asset management, and wealth protection. We are different from the sense that we dig in, we do everything with you, and we're truly your partner in your pocket when it comes to finance. And with me, I have Lisa Mrakll. She's a senior tax advisor, like a total boss when it comes to knowing tax law and taxes, planning, everything that goes with it for not only individuals, but business owners as well, which I know is super important for a lot of you out there. What I love most about Lisa is she is not a generalist. She is a specialist. She knows her shit and she knows exactly how to plan, prepare, and when to integrate other advisors so clients get the maximum experience as well as opportunities when they are looking for a full plan. So Lisa, welcome.
Thank you so much. It is so awesome to be here. Thank you for that amazing introduction. I am Lisa Mrakll. I am a CPA with Tronconi, Segura and Associates. We're a consulting firm, CPA firm, advisory firm locally here in the Williamsville, New York area. I have had my CPA license since, for about 20 years. I have about 24 tax seasons under my belt, have seen just about everything. Focus on individual tax planning, advisory, tax strategies, in a lot of small businesses as well, just because of the nature of the way our community here in the Buffalo area is built. There are a lot of small businesses in every shape and size, whether that means the level of, honestly, just the level of hand-holding they need, that we're here to kind of quarterback all those services for them, from just getting their initial set of books and chart of accounts set up, all the way to formal financial statements if need be. If they need a full-blown audit, we're here. But of course, all of the tax compliance and planning as well. So great to be here. And we have got a lot of job security going on these days with following the legislation all spring into the summer, and seeing the bill get signed on July 4th, trying to figure out what it's called now so that we don't get in trouble. But
Right.
it's probably going to happen. It's just the longest acronym ever, and we thought Tax Cuts and Jobs Act was a mouthful, but this is even worse. So I think it's actually officially called One Big Beautiful Bill Act. So I just keep calling it the Act.
It is.
I love
Yep.
that.
The one big, and it doesn't sound like an actual legal name that was signed into law. And and it's hysterical because between the two of us, Lisa, we have like over 36 years of experience combined, and I also feel like I've seen it all. I've seen all, like, definitely not. There's always something new and wild that comes into play. But I think some people feel like it, depending on what side, it's a little bit unfortunately politicized. And so we are being neutral here. I just want to be clear about that.
Absolutely.
Neither Lisa nor I represent any political party whatsoever. But we are really here to just give the facts. That is the actual name of the bill. So, as wild as it may be, but we want to educate you guys. We want to make sure that you have the tools in hand, the information in hand that you need to make really prudent decisions, ask good questions, and ultimately do a good job strategy planning so that you can keep as much money in your pocket as possible, pay the least to the government, or we want to be strategic with how you're paying those taxes to, again, mitigate over time and just plan well. So, with that said, Lisa, can you just give us who benefits from this bill? If you have a good overview, I think that would be really helpful, because there is a lot of confusion right now in terms of who is to benefit and what that looks like.
Oh yeah, absolutely. The evening of July 4th, I got a phone call from someone in my family who said, "Oh, does this mean that I get a big fat check because of all the overtime I worked?" And so people already are very confused. They want to believe what they want to believe, and that this is going to be a huge windfall for some of these different categories of workers, which in a way it might be, but we'll see. But yeah, we definitely have a lot going on, and there definitely are groups of people that this will benefit. But and honestly, it's going to benefit people like you and me a lot because we finally have certainty. We finally have information we can use to sit down and concretely say, here's finally we know what the rates are going to be. We know what the brackets are going to be. Just so many benefits there in terms of sitting down and actually, looking at someone's all their information, planning out whether it's for the next quarterly payment in
Mhm.
September. How can we maybe tweak that a little bit? Or for the rest of the year into tax time, reducing those surprises, sending less money to the government if possible. So I think we're going to be very busy. Dozens and dozens of, I think, pages we're going to be interpreting over these next few months. There's already talk about not modifications to what has been passed, but confirming the interpretations. I think that are starting to come to the surface. Whether it's how to handle. I mean, we won't really get in too much technically into the business aspects today, but certainly going to mention things like bonus depreciation, the R&D situation, and now being able to expense those. I mean, there's a lot that's going to have to be unraveled, and then it's all has to be buttoned back up to be able to produce tax forms and tax instructions. And we're all chomping at the bit here on the CPA side going, all right, we need our software updated. We need to plan. We need to roll things out. We need to crunch numbers, crunch. So that's not happening as fast as we'd like it to, but at least we know, that we don't have to plan for all these what if scenarios based on the estate tax exemption and the rates and all that stuff. So
Yeah.
so it's coming. Obviously, businesses, there's going to be some really nice benefits. This with the SALT cap, we're going to get into that a little bit, I think. So we can actually provide some concrete answers for people and not just not just surmise and speculate anymore. Finally.
Yeah, that's right. I find whether the news is good, bad, or indifferent, certainty
Mhm.
and clarity is huge,
Yep.
just so that way we do know
Yeah.
what to do moving forward. So I agree.
Yep.
And why don't we start with talking about seniors, Social
Yeah.
Security.
Yeah.
I think this has been most definitely a hot topic of conversation. Again, there's confusion around this, and
Yeah.
I think the some news outlets have promoted it as Social Security now is tax
Right.
free, and that's not
Right.
really the case.
Right.
So, can you
Right. Yeah.
explain now with
Sure.
this new bill how it's working for seniors, that special deduction, and how it impacts
Mhm.
Social
Yeah.
Security?
Oh, absolutely. Huge part of the campaign. The presidential campaign, quite honestly, and this was a campaign promise. So we are now seeing what that is going to involve. So that was no tax on Social Security, and some people can still interpret it that way, and it might actually mean for them that wow, none of my income was taxed for whatever reason. Um, so this is what came out of this with the bill act um, is a temporary deduction called the senior deduction. So it's for taxpayers 65 and older and their spouses if filing jointly. They each can claim a $6,000 deduction in 2025. So starting right away this year, which is awesome,
Mhm.
through 2028. So it is temporary. So it's going to be reduced a little bit by about 6% with those with AGI, adjusted gross income that exceeds 75,000 or 150,000 for joint filers. So a bonus of this change that it leaves more room, for things like Roth conversions and maxing out tax brackets if the situation allows. So a lot of people still think this means no tax on Social Security. Call it what you want. It's a deduction.
That's
It's a
right, and I
deduction. It's
think
not a credit.
yeah, and it's important for people to remember that, I think there's been confusion, especially me talking in what we do, that some people did assume it wasn't taxable. And Social Security is taxable up to 85%. So
Mhm.
this will reduce the amount of which it is based on your total income, that adjusted gross income that you mentioned, Lisa. And
Exactly.
so with that, I do think it's important for everyone to just sharpen the pencil and review. One of the things that we've been doing a lot with our clients is really digging into those Roth conversions. Does it make sense to do it this year, and or should we be doing more, right?
Mhm.
And we're going back and forth with the accountants and kind of running the scenarios in terms of how much more can we do to stay within the same tax bracket. And then long-term planning, this is temporary, right? It's only 4 years.
Yeah.
So
Yeah.
looking at the total portfolio, what your income looks like, where the distributions are coming from, how can we be strategic to maximize
Mhm.
this bit of
Mhm.
savings right now? And then what we're doing is formulating and looking at the long-term impact as well, and what that is, because not it won't make sense for everyone,
Right.
depending on your
Mhm.
scenario, but definitely something to dig into. Another thing to look at as well, outside of just Roth conversions alone, are if you have any capital gains you may want to recognize or
Mhm.
rebalance
Mhm.
non-retirement portfolios as well. Depending on those amounts, they may not be taxable at all over the next 4 years, or at a lower amount, because again, long-term capital gains are bracketed based on income.
Mhm.
So really important to just start looking at these details and being strategic, because this is for some people a nice window to reduce taxes there. So
Mhm.
and then one other note too before we move on this is some seniors are getting subsidized health care. So in health insurance, Medicare, and those supplemental
Mhm.
plans are also
Mhm.
based on taxable income. So this is
Right.
another thing to just keep in mind, as well as we're planning out to maximize every single moving part.
Yeah.
So um,
That's important. That's an important
big thing.
distinction. I think we need to keep in mind today, and certainly for all of our clients, is that when there's deductions, we need to make sure we're understanding if is it coming from taxable income or off of above the line? Is it off of modified
That's
adjusted
right.
gross income? So that is a big distinction in terms of phase outs, whether it's the medical expense deduction or the subsidies for healthcare, things like that. So I don't think we can remind people enough that of that distinction.
Yeah.
Excuse me.
And to not read headlines and forget the details, please, for the love of God. You guys, like, ask us questions. That is what we are here for a resource.
Right.
Please do not just read headlines, because they are very misleading in a lot of different scenarios. So and
Huge,
this is in
huge
like,
headlines associated with overtime and tips. I think are
oh
we
yeah,
getting into that
yeah,
next year? Yeah, yeah,
that's right. So overtime and tips. So
yeah.
this again, this is written in. He talked about it on the campaign trail. So
Mhm.
there is no tax on overtime and tips until
Mhm.
there is. So Lisa, why don't you
Right.
talk about that, the details behind
Yep.
it, and how this one works?
Okay, so we'll start with overtime pay, the new benefit on overtime pay. Historically, overtime pay defined as compensation for hours worked over 40 hours in a work week has always been taxable under the Internal Revenue Code. Employees pay regular income tax on that, so your ordinary income tax rates, and the payroll taxes on all the wages, including all the overtime. So the TCJA, so those were the tax rules in effect starting in 2018 that were set to expire at the end of this year. Those are all now permanent. The TCJA did not address any elimination on overtime, but this new act does, and it's a temporary deduction again for individuals who receive qualified overtime compensation. So it's going to be a $12,500 per year in qualified overtime compensation, or $25,000 for joint filers. Again, this is an above the line deduction. It does not reduce taxable income. It reduces modified adjusted gross income. And again, it's still a deduction. It's still going to help the big picture tax wise, but if you're looking for it to affect any other types of phase outs, we have to really watch. That's a fine line there. So speaking of phase outs, you can't have unlimited amounts of income and have this deduction still be in play for you. For single filers, if you are making $150,000 or more, you are going to be phased out of this deduction. And so $300,000 for the joint filers. So how's this all going to work mechanically with payroll companies? Well, we are hoping it's not too painful. I think this year, 2025, because it is starting this year, is going to be it's going to be interesting. But payroll companies, they've anticipated this. I'm sure they've been formulating how they're going to roll this out. they're going to have to report the overtime on the W-2 and really in a new box. It's not like for tips where there already was a box. There's going to have to be a new box on the W-2. So, and on 1099s for non-employees. So
Mhm.
very interesting there. So this is available to those who itemize deductions and those who do not. If you want me to, I can get into what those two things mean differently. So if taxpayers take the standard deduction, this is going to be in addition to that. So that's really cool. Withholding tables. So those are the tables that determine how much of our income is subject to how much in taxes are being taken out in each paycheck. Technically, it's a percentage based on small brackets of income. And so they're going to be updated next year from what I'm reading most recently. So the benefit is realized earlier by people and won't have to, won't see the big windfall, as it were, at tax time. They'll actually see that money in their paychecks throughout the year instead. Not exactly sure how that's going to work if people have multiple jobs with multiple, overtime, multiple jobs where they earn multiple overtime, boxes on their W-2. How are they going to know when that phases out and when to adjust that withholding? All going to be interesting to see how that rolls out. But tips is going to be similar. So tips is no tax on tips is going to be for those employees where tipping was customary to them in their profession before 2025. We can all, really concur on who all those different types of professions were. All of our restaurant workers, salon employees, barbers, estheticians, all even the owners of those establishments that might be customarily getting tips too. I have several salon owners. They are on the payroll themselves and certainly earn the tips, but we've just
Which
got
is
to
just a
watch that
huge, huge
income phase
point.
out.
Yeah, and to your point, Lisa, of if you have a few different jobs where they're not going to communicate to each other, right? It's very similar
Correct.
where if you're working two
Correct.
different
Yep.
jobs and they each offer
Yep.
a 401k plan, it's really on you to track that. And so this
Mhm.
is where, again,
Yep.
it can be really helpful to make sure that throughout the year you are communicating with your tax professional to
Mhm.
make sure that you're anticipating what could potentially be owed back when
Right.
you do file your
Yep.
taxes. So
Yep.
you want to pay attention to that. And one of the things that we saw a lot when the Tax Cuts and Job Act rolled out back when is that payroll companies didn't all get it right. And
Mhm.
withholdings weren't correct for the
Correct.
first couple of years. And there was a lot of frustration with individuals when they owed taxes at
Mhm.
the end of the
Mhm.
year when they filed. And
Right.
many people pointed a finger at their employer, at the payroll company, and unfortunately, even if they didn't get it right and it was miscalculated, it's still on you to understand that. And you're still responsible for paying those
Mhm.
taxes, even if it hurts
Right.
a little bit. So
Right.
I would encourage everyone as these changes start to roll out, just to make sure that you are monitoring the payroll withholdings, what it looks
Mhm.
like, that it's accurate. And again, if you have questions,
Mhm.
that's what Lisa is
Yeah.
here for, or the accountant that you are working with. Really, really important because you don't want those surprises. This is especially true for business owners as well, and some
Mhm.
of the other things that we're going to be getting into here shortly when it, for those small business owners. And one other little point that I want to just mention too, because this really isn't in, I think, what we plan to talk about today, is that you had mentioned, Lisa, that you can utilize these deductions even if you're not itemizing. Most people
Mhm.
don't itemize because the standard deduction now, since the Tax Cuts and Job
Yeah.
Act, is so
Right.
high. So you can take advantage of that, which is huge.
Right.
It really is a nice
Absolutely.
benefit. And there's also the tax deduction, which also you can take advantage of this, I believe, Lisa, if you are not itemizing on your car loan interest
Mhm.
if you
Mhm.
are
Yeah.
under a certain income threshold as well. So there is, of
Right.
course, a phase out for that too. But many of you guys listening may have a higher interest rate on your car loan, especially within the last few years, and has vehicle prices have really gone up. That is another little thing too that I just wanted to make mention of to ask the question so that you guys
Mhm.
make sure you really are taking advantage of
Yeah.
everything.
I can dive into the auto loan interest. We're learning more and more about this every day. I've heard everything from the automobile has to be be, the final assembly has to have taken place in the United States. Okay, fine. There are a lot of cars that still are, thankfully, but apparently there is one of the letters towards the middle or end of the VIN number that if it is a certain letter, it means that it will qualify. It was final assembled. And I thought, okay, so I'm thinking about my own cars. I'm like, oh, good, check. Then it cannot be a lease. It has to be financed or
Makes sense.
regular financing. You have to be the first owner of the vehicle. So you can't have bought a used vehicle. It has to be a brand new vehicle. Okay, so that knocked me
An
out.
important
Knocked a
detail.
lot of
Yeah.
people out. I mean, it's going to be interesting to see how many people actually take advantage of this. I heard a really interesting technical scenario about this, and it's like, oh yeah, that really is going to be a slim group of people that can take advantage of it. But we're certainly going to, we have a whole new system that I would imagine we're going to be putting in place of asking folks about these new deductions we want to make sure we ask everything and throw in the kitchen sink. And if they don't qualify, fine. Well, at least they asked. We want them to hear it from us first. I know you are the same way, which is awesome. Yeah.
100%.
So we'll see. I mean,
Double
it
is
would have to
always
be
the
a pretty
detail.
high interest rate, pretty big loan, pretty high interest rate. Okay, so if you can afford that type of vehicle that is going to generate that much interest, you probably make over the phase out. So that was kind of where what I had heard in the explanation. I'm like, yeah, that actually makes a lot of sense from a number standpoint. So we'll see. I hope a lot of people get to take advantage of it. Do you want me to
Thank
get
you
into tips a little bit? Because then I want to ask you about, if people do find that they are going to be in a little bit of a more positive cash flow situation with some of these deductions, like what's going to happen from, the standpoint of, well, maybe I need to bump up my emergency savings when I wasn't able to before, retirement deferrals, things like that. But yeah, real quick on tips, kind of a similar concept to overtime. It's going to be limited to up to $25,000 per year per taxpayer. It phases out $100 for every $1,000 of modified adjusted gross income over the $150,000 level for single taxpayers, $300 for joint filers. The way that's going to be reported, again, that remains to be seen, but there already is a box on your W-2 for tips. So that's going to be utilized for that, I have no doubt. So by the time the IRS finally gets all these instructions and forms out, it's probably going to be well into January, I would say, when they open for filing season. And then we very fortunate CPAs and accountants get to ramp up in about, a couple of weeks by the time really all the individual tax info starts coming in and we start preparing. So it's going to be interesting for sure. We're going to be busy.
Yeah, you will. They've got a lot of work to do, and if you are someone who is going to be benefiting from reduction on your taxes on overtime or tips, we are absolutely encouraging clients to consider taking that savings and putting it somewhere as if you still aren't earning it. So it's a great way to increase savings for retirement, boost your emergency reserve if you need to, maybe pay off high interest debt. So depending on where you fall on the spectrum there, the impact could be pretty good. So we want to make sure that those dollars are being used toward very effective things, if you will, or proactive things rather, that maybe you weren't able to take advantage of before. And even if it feels like a small dollar amount, I promise you, when you allocate them toward things like retirement or getting ahead of paying off debt, it really does snowball and add up quickly. So every dollar counts, you guys, in what we're doing here and putting toward the bigger picture, the bigger goal. And shifting gears now, really let's think and talk about the SALT deduction increase if we can, Lisa, because that is another big change. And this really is important to also differentiate between those who are itemizing, not itemizing. And then we'll talk about some planning opportunities there.
Yeah, this again is going to make a huge dent in people's taxable income. So we're gonna dive into this now. Yeah, so I definitely think it's a very welcome change to many taxpayers. We've been really living with the consternation of a lot of our taxpayers in our higher tax states that they are limited to deducting $10,000 in SALT or state and local tax. So just to back up as a refresher, we've got two ways to reduce your taxable income. The standard deduction, which depends on your filing status. It's a flat number. It took a huge jump with the Tax Cuts and Jobs Act. So we saw a lot less people having to track their charitable deductions, you know, deducting mortgage interest, and they were capped out at 10,000 for state and local taxes. So there was just not as many taxpayers itemizing. A huge drop. Not 90%, I think, were taking the standard deduction, maybe even more than that. So the standard deductions are still pretty high. They stayed at the same levels, and they're getting boosted with inflationary adjustments. There's supplemental amounts if you're 65 or older. If there's blindness for the taxpayer spouse, those deductions can get up to another 4,000, depending on what scenarios the taxpayers have. So standard deductions are still really high, but we're going to be focusing even more so on optimizing between the standard deduction and all these potential itemized deductions, which is a group of deductions in a few categories. Medical expenses, as long as they exceed 7.5% of your adjusted gross income. It's a tough hurdle to get over for a lot of people. Thankfully, I mean, there's not a lot of medical expenses that are out of pocket for people, but we've seen it happen. We've got our state and local taxes. So these are going to be the state income taxes you pay or have withheld on your paycheck every week. What are you paying quarterly estimates to your state, et cetera? Property taxes. And then depending on the state, there could be some other things too. But for generally speaking, those have been capped at 10,000. A lot of unused deductions there in income tax and property taxes, depending on where the taxpayers reside. Mortgage interest is part of the itemized deduction group, not home equity interest. And then, of course, we have charitable deductions. So we're going to ask for all the information so that we can compare. Is the standard higher than the itemized? And we actually kind of want to start looking at this now, to be honest, because we can bunch deductions in 2025. I was
going to say that. Yeah.
Because you might be a very charitably inclined person and might have heard about this donor advised fund thing, and I'll worry about it another year. But if something else is going on with your income and there's a bonus that you're going to be getting unexpectedly, maybe this year, as opposed to it being pushed out into January, whatever the case might be. Okay, let's that income's coming in. We can't do anything about it, but we can maybe bunch some deductions that we were planning on making anyways to a charity, whatever the case, accelerating maybe some a mortgage payment, accelerating a property tax payment, whatever the case might be. That cap, that $10,000 cap, is now $40,000. So we've got a lot of room there to play with.
Difference, especially for everyone listening in New York State, and in those of you in California. I mean, the two highest states, and Texas too is a good contender.
There's a phase out. Yeah, there is the phase out at 500,000 of income.
Yes, thank you for mentioning that. That was on my radar. So this isn't, you want to make sure that you qualify. And then if that is the case with the 500 and you're not sure where you're going to fall, especially if you own a business, again, this is why it's really critical to start having conversations with us now so that we can be strategic. Are there ways that we can potentially reduce that income? What are we looking at? And by reduced income, I mean, be thoughtful on the strategy in who else you may be paying, especially if you maybe have children old enough to be in the family business. We can talk about strategies for that. That is not for this conversation, but something that we're doing a lot with our clients and talking about, and on the donor advised fund and the stacking that Lisa was referencing here, I just want to unpack that for a second. So first, we are able to actually write donor advised funds and open them up for clients. It has been a big conversation. And what donor advised funds are is they allow you to make a charitable contribution and take the entire deduction in that year you make it. So for example, if you just sold your business and you had a cash windfall, maybe you've got a few extra $1 million this year, or whatever amount that is, you can, if you are charitably inclined, and typically maybe you tithe every single year, or you do a percentage of your income, what you can do is do that entire 10% of your business sale in this calendar year to maximize that charitable deduction in that donor advised fund. But then throughout the next 20 years, 10 years, you can choose any qualified charity and give over time. A lot of clients like this because you're not then forced to give a lot of money to one charity in any given year. I know some people are very uncomfortable with that, especially if it is your church or organization. They're not accustomed to getting that kind of money as well. So the responsibility of it getting spent may not be aligned. So these are really critical planning points, and the bunching. So if you are someone where you're kind of on the line between whether or not the standard deduction makes sense and or itemizing, what we are talking about with clients is saying, hey, this year, why don't we bunch everything that we can, meaning charitable deductions. You can pay your property taxes in advance sometimes, and all in that year, as well as extra mortgage payments. And maybe you have extra medical expenses in this year, or maybe it'll be next year. So we can always be strategic about this, bunch all of those itemized deductions to really maximize that amount. And then in the following year, we can take the standard deduction because you had already prepaid, other things in that year, and toggle back and forth. So something that I don't want to spend too much more time on because we got to get moving along here, but it is an important planning concept and something that we're definitely digging into with clients. And again, just making sure that, to your point, I think you said this earlier, like we are looking under every rock, man. Like we don't want to miss anything, especially with this stuff.
Absolutely.
So,
it's amazing how much is going on right now. It's just like,
yeah,
I love it. Like I'm a total geek. I'm geeking out. Like I just love this stuff. But
part of the puzzle.
I know the thing is like, we're going to be really busy, like in the fourth quarter. Like I can already see it. It's going to be nuts. So heed our advice as much as possible. I hope everyone out there will do this, which is what we were doing with the possible estate exemption crashing, at the end of after this year. There was the lawyers were getting busier and busier the more the year went on, and we weren't sure what the exemption was going to be. Now I think it's back on us, Nicole, people like us, because we are going to be cranking out. We're going to be getting into the nuts and bolts of things that really matter to such a bigger portion of the population, not the 99. Now we're looking at the 99%, not the 1% with the estate issue. It's everybody else now. Everybody else gets a turn to benefit from some tweaks to their deductions, and really being able to take advantage of what's going on with this new bill, the act, the OB Kenobi, whatever it is.
And on the vein of deductions, why don't we talk about how now 100% depreciation is back? So this is important again for two categories of people: business owners and real estate. So we'll talk about real estate first. And we have a ton of clients that are real estate investors, own rental properties, and if you are someone who has a rental property that you do plan to keep for a long period of time, this is a special planning point. And there are some nuances and caveats there. Of course, this is not direct advice, just information that we're giving. But because that 100% depreciation is back, it may make sense now where it hadn't before to do a cost segregation study on your rental property, where you're really able to go back in time, bring a bunch of deductions forward. And so this is something that we've been bringing up to clients where it just hadn't been worth the conversation before, to now dig into and really this is where collaborative work matters, where you've got the cost segregation expert, your financial planner, your CPA, all communicating to see if the cost maps out to the tax savings, and if the win makes sense. But and then of course equipment for business owners, 100% depreciation, again, big deal. So Lisa, why don't you dive into that a little bit, what it looks like, especially in New York State, because again, of course, New York has its own caveats. So that would be helpful for people to hear, understand, and again, strategy for this 25 year and the next few ahead.
Cost segregation is huge. It really always has been, because what that essentially does, and I know our professionals here at Tronconi, they have built a very amazing service about around doing cost segs. for businesses of all shapes and sizes. So it's awesome to have that expertise right here and bounce those strategies off of them.
And real quick, I don't want to interrupt you, but that
Yeah,
is very unique. So a lot of CPA firms don't have
that's
in-house
why
cost
Spirit I mentioned.
segregation experts. Yeah.
Yeah.
And the fact that you do is huge because it also saves the client money by not having to pull in a third party.
Yeah.
And there's really there's better continuity
Yeah.
of planning and information too. So
Yeah.
just
Absolutely.
as a little digression there, but carry
Yeah.
on.
Yeah. No, I'm involved in one now for a dental group, and they put the building into service in 24, and the tax savings is just mind-boggling, and the client is absolutely ecstatic. And he didn't even know what it was or that it was a possible scenario strategy for him. But because the client keeps us informed, we were able to explain what this was, and the value he's getting is just phenomenal. But anyway, so 100% depreciation really just means if you have a qualifying asset, and I can certainly answer questions as to what those are. Maybe that's outside the scope here today a little bit, but for the most part, putting an asset in service, you're going to be able to take 100% expense that item at 100%. It's called bonus depreciation. It was set to it was set to phase out, I think, by 2027 completely. I think we were at
Mhm.
40% deduction this year. The TCJA had it phasing out in 27, so I think it was 20% next year and then completely gone in 27. So it's back 100% and it's permanent. That
And
has
what
to
in
be,
ser oh,
yeah.
sorry, Lisa.
I
I
was going
just
to say
want
it
to
just has
make
to be
clear
considered.
because there's confusion around this too, what in service means. So in service means that you have it actively rented or you're actively using it for your business.
Correct.
So
Correct.
you cannot just buy a building this year and not have it rented out yet. Maybe you're working on renovations and take advantage of that. So that is a
Right.
very clear line in the sand that
Right.
I get a lot of questions on. So sorry, Lisa. I just want to make
Yeah,
that
no, I
clear.
think even for those, even for those the landlords, if it takes you a few weeks or a month or a couple months to actually get tenants, if you've opened for business and you're actively marketing and advertising the property, it's in service. It's in service
Great,
as far as
great
we're
point.
concerned. But so, anyways, I just wanted to say too, New York State decouples from 100% to bonus depreciation. So while you're getting a huge write off for New York, you'll have potentially what's called an add back for state purposes. So there's not 100% bonus depreciation for New York State or any bonus depreciation program. It is maker's depreciation. So,
Great.
but you can also consider the widely expanding Section 179 expense. That is not going away. That just continues to get bumped up in terms of the limitations, the amount of expensing that you can play with there. It's just amazing. Well over. I was going to grab the exact number, but it's for all intents and purposes, it's like 1.5 million ish of assets you can place in service. Take 100% of those as an
Mhm.
expense. State and the state follows that rule as well, which is great.
Yeah. Yeah. And with a lot of these changes too, it is important to make sure, depending on the state that you live in, what's been adopted or not in those
Correct.
nuances. But, as you guys can tell, there is so much in this
Mhm.
bill. There's a ton to unpack, to talk about, importantly to plan for. So do not be procrastination Polly here. Please
Mhm.
make sure you're being proactive and talking to your advisors and having the conversation so that we can truly do the best job for you. The
Mhm.
worst thing to do, and I know, Lisa, this is definitely something that I'm going to use this expression, frost your chaps in mine as well, is when you get that fire drill email or phone call from a client like the day before the tax deadline. Oh my gosh, I have all this to do. I'm going to get you all my information. I need an answer right
Mhm.
now. Like,
Mhm.
if we don't have adequate time to research, plan, prepare, ask good questions, we don't have the ability to find as many opportunities as we possibly can.
Right.
And a lot of these opportunities and strategies we need to do in the current calendar year. We
Yep.
can't wait until next
Mhm.
year to go back.
Yeah,
So
that's
I cannot stress that to you enough. And there's so much more in this plan that we haven't had time to unpack in this session. So there's additional increase in S Corp, the QBI deduction. There's stuff to talk about for some nuances in 529 plan changes, the
Yeah.
MAGA
Yeah.
accounts, which
Yeah.
we didn't have time for today. And the MAGA accounts, I think, are going to be a little bit of a mess because
Absolutely.
there's not clear instruction on that quite yet, but we do have all the details. So, please
Mhm.
reach out to us. We're going to have a link directly tied to this video for you to ask us questions, pick our brains, let's connect, let's
Anything.
communicate,
Absolutely anything.
and
Yep.
yeah, keep the conversation going. So, Lisa, thank you so much for your time today. I
Thank you.
appreciate
This
it.
was
You are
awesome.
clearly a wealth of knowledge.
So are you. This was super fun. Yeah, there's a lot going on. Uh, you mentioned 529s with people, including myself, getting the college tuition bills. Take a step back, see what you can actually withdraw right now. You can make these new qualified withdrawals starting with July 5th of this year. So as you're paying tuition and taking money out of your 529s, call Nicole, call me, email us, ask us your questions about what can be used with those funds. It's widely expanded. So
Yeah, thank you. So much to
lots to
do.
come.
So that's
Absolutely.
right. And we will continue to keep you guys updated along the way. So until next time, continue to be courageous. Let's stay connected and we'll talk to you soon.
Bye.